The Deep Dive, sponsored by BigBrainAI, where 6 AI models analyze every trade, every game, every market, so you don't rely on just one opinion. One consensus, zero bias. That's BigBrainAI.
I promise you a better tomorrow, a stronger nation for everyone.
Buy, get me 50,000 now.
Woo, yeah, let's go.
I want to start today with a question that might make you a little uncomfortable. How confident are you, really, in your predictions for this week? And I don't mean casual stuff like, oh, I think it might rain.
Yeah.
I mean, if you had to put cold, hard cash on the table, your own money, how much would you bet you know what's coming?
It just changes the dynamic completely, doesn't it?
Yeah.
I mean, opinions are free. You can say whatever you want about politics or the market or who's going to win the Super Bowl. But when you have to actually open your wallet, that's where things get real.
Exactly. And that is what we are unpacking today. We aren't just looking at headlines. We're digging into a deep analysis of something called Polymarket trends. Basically, we've got this massive stack of data that shows where millions of dollars are flowing in these prediction markets.
Yeah, you should think of it as a roadmap to the future, but one that's crowdsourced by people who have a financial incentive to be right. And the data covers, I mean, everything from the Federal Reserve and a possible government shutdown to, believe it or not, the 2026 Oscars.
It is a wild mix for sure, but the mission for this deep dive is really specific. We want to see if we can find what the source material calls the consensus advantage. Basically, what does the collective wisdom of thousands of bettors, what do they know that the rest of us might be missing?
It's the difference between listening to a pundit shouting on TV and, watching where the smart money is actually moving. One is noise. The other is a signal.
Okay, so let's follow the money. And when I say money, I mean a lot of it. We have to start with the financial sector because the trading volumes here they're just astronomical.
They really are. And that makes sense, right? If you're a global investor, you have to hedge your risks. And the biggest blip on the radar right now is the Federal Reserve.
The numbers here just blew my mind. We're looking at the Fed's January decision, and there is $592 million in trading volume on this single topic.
Almost $600 million. That tells you this isn't casual gambling. This is what you could call institutional anxiety. The market is desperately trying to price in what the Fed is going to do. When you see volume that high, it means that single decision is the most critical variable for the global economy right now.
I want to pause on that term, institutional anxiety. We're not talking about guys in their basement betting $5. Who is actually placing these kinds of bets?
It's likely hedge funds, huge asset managers, corporate treasurers. They use these markets basically as insurance. So if a rate hike would cost your company $10 million, you might bet, say, $1 million that the hike will happen. If it does, you win the bet, and it helps offset your business loss. That's why the numbers get so big.
So it's a hedging mechanism. You're basically paying a premium to protect yourself against a future you don't want.
Exactly. And because they are putting real capital at risk, the signal is incredibly pure. They can't afford to be ideological about it. They just have to be accurate.
Now, it's not just about policies. It's about the people, too. There's a lot of speculation around the Fed chair nomination.
Right. Who sits in that chair pretty much determines the direction of the wind. And there's $273 million traded just on who Trump is going to nominate.
Okay, so who's the front runner? Because these things usually feel like a total toss-up.
Well, the markets seem to have a clear favorite. Right now, Rick Rieder is leading the pack. He's sitting at a 47% chance.
And for those who don't follow Wall Street personnel, Rieder is a top guy at BlackRock, right?
That's him. He's the chief investment officer of global fixed income, a very establishment finance pick.
Which is high, almost a coin flip, but it's definitely not a done deal.
No, not at all. Kevin Warsh is trailing him at 28%. Warsh is a former Fed governor, a bit more on the hawkish side of things. But what's interesting is that gap. The market is favoring Rieder, but there's enough money on Warsh to suggest that, insiders are still hearing conflicting whispers.
So you've got the BlackRock executive versus the former governor. It's like a battle for the soul of the central bank.
It is. And the market is telling us that stability, represented by Rieder, is the preferred narrative. But there's a big minority betting on a harder line with Warsh.
Speaking of the Fed, I have to bring up my favorite stat from this entire pile of research. This is where these markets go from serious financial analysis to just obsessive detail.
I think I know which one you're talking about.
It's the Jerome Powell press conference. You'd think people are betting on rates going up or down, but no. Traders are betting on his specific vocabulary.
It's incredible, the granularity.
Get this. There is an 87% chance that Chair Powell mentions the word inflation 40 times or more.
40 times.
40 times. Who sits there and counts that?
Algorithms count that. And traders who have analyzed every single transcript he's ever given count that. But think about what that 87% chance actually means. It tells you the market believes the Fed's entire focus is still squarely on inflation. If they thought the economy was cooling too much, you'd see bets on words like recession. But inflation 40 times. That says the fight is not over.
It's really about forward guidance, isn't it? The market trying to decode the Fed's psychological state.
Precisely. In economics, forward guidance is just the Fed telling us what they plan to do so we don't all panic. If Powell says inflation 40 times, he's signaling he's not ready to cut rates. The market is betting he's going to be very boring.
Or it's very repetitive. Yeah, that's a cool, if slightly neurotic way to see it. It's linguistic analysis backed by money. Before we leave finance, though, we have to touch on the corporate side. Tesla, TSLA.
Always a hot topic.
But the sentiment here seems a little lukewarm.
That is, putting it gently, the contract that's tracking whether Tesla will beat its quarterly earnings.
Yeah.
It's sitting at a 29% chance.
Ouch. So less than a 1 in 3 shot. They have a good quarter.
Correct. And remember, this is crowd wisdom. This is aggregating everyone, from Tesla superfans to the harshest short sellers. When the dust settles, the consensus is that they're probably going to miss the mark. It just cuts through the hype.
It's a reality check. Okay, so the financial outlook is heavy on inflation talk, light on Tesla optimism. But if you think the financial markets are stressful, let's pivot to something even more chaotic. Domestic politics.
Here we go.
The source material highlights this massive immediate crisis, a U.S. government shutdown. And checking the date on this, it says the deadline is this Saturday.
And the odds are not looking good for keeping the lights on.
No. Polymarket has it at a 75% chance that the government shuts down this Saturday. And people have traded $14 million on this.
That 75% is a very, very strong signal. In prediction markets, once you cross 70%, you're usually looking at a likely event. The market has basically priced in the dysfunction. They are not expecting a last-minute deal.
I want to dig into that idea of being priced in. We hear that all the time. When we say the market has priced in the shutdown, does that mean the stock market won't crash when it happens?
Ideally, yes. It means traders have already sold off risky assets and bought safer ones in anticipation. The surprise is gone. If the shutdown happens, everyone just nods and says, yep, we knew that. Ironically, the market would probably react more violently if the government stayed open. That would be the surprise.
That is a wild way to think about bad news. The chaos is already on the balance sheet, and it gets worse. They're not just betting on if it happens, but for how long.
Right. The data shows a 76% chance it lasts more than one day. So the consensus is this isn't just a ceremonial few-hour thing. It's going to be a real disruption.
It's amazing how specific these contracts get. It's quantifiable chaos. Speaking of which, let's talk about the cabinet.
The Trump cabinet departures market.
This feels like reality TV. Who gets voted off the island first?
It essentially is. We're treating governance like a spectator sport.
So who is the market betting against? Who's packing their bags?
The current favorite to exit first is Kristi Noem. She is leading the pack at 38%.
Wow, that is almost a 40% chance of being the first one out the door. That's rough.
It is. And trailing her is Pam Bondi at 17%. That gap between them suggests there is a specific vulnerability with Noem's position that the market has latched onto. Maybe it's a scandal, maybe a policy clash, but the money says she's on very thin ice.
It is wild to see careers just distilled down to percentage points. But if we want to talk wild, we have to talk about the Greenland trade.
Ah, yes, the geopolitical real estate deal.
I thought this was a joke when I first saw it, but there is real trading volume here. The question is, will the U.S. acquire part of Greenland in 2026?
And what are the odds?
The market gives it a 23% chance.
Roughly 1 in 4.
And there's another one. Will Trump acquire it before 2027? That's at 12%. I mean, buying Greenland, why is there actual money on this?
It sounds absurd on the surface, but you have to stop and think about why people are betting on this. It speaks to the unpredictability of the current geopolitical era. In a normal, boring timeline, that percentage would be 0.
Right, you wouldn't bet on the U.S. buying France. It's not on the bingo card.
Exactly. The fact that it's 22% tells you the market believes we are in an era where unprecedented historical land deals are actually plausible. It's a measure of the strangeness of the times. It's what finance people call tail risk.
Okay, can you explain tail risk a bit more for the listener?
Sure. So imagine a bell curve. Most things happen to the big, fat, middle, the average stuff. The tails are those tiny slivers at the very ends of the curve, the extreme events, a pandemic, a massive crash, or buying Greenland. They're rare, but smart investors always put a little bit of money on the tails just in case the world goes crazy.
So betting on Greenland is basically buying a lottery ticket on history being weird.
That's a great point. It's not about the ice. It's about the audacity. And speaking of global moves, let's zoom out to geopolitics. Because while Greenland is quirky, this other stuff is, well, it's pretty scary.
This is where the stakes get incredibly high. We're not talking about cabinet shuffles anymore. We're talking about war.
The volume on this next topic is $110 million. And the question is, will the U.S. strike Iran by mid-February?
Over 100 million traded. When you see 9-figure sums on a conflict prediction, that's what we call a fear gauge.
Explain that. Who puts $100 million on a war?
Major international companies, oil futures traders, logistics firms. Imagine you're a shipping company. If a war breaks out, the Strait of Hormuz closes, your shipping costs triple. You might bet, yes, a war will happen. If peace prevails, you lose your bet, but your business is fine. If war happens, your business suffers, but you win the bet and cover your losses.
So it's not warmongering, it's risk management. It's just business. Exactly. They are buying insurance against chaos.
So if the volume is that high, people are genuinely worried.
They are paying very close attention. It turns the rumors of war into an actual price tag.
And connected to that, there's movement regarding Iran's leadership specifically.
Yes, the stability of the regime itself. There's a contract with about 2 million in volume asking if Khamenei will be out as supreme leader by February 28th.
That is a very tight timeline, the end of February.
Very tight. And the odds are sitting at 19%.
Almost 20%. A 1 in 5 chance.
Which is significant for a leader who's been in power for decades. A 19% chance of a sudden exit in the next few weeks suggests the market is picking up on instability, health rumors, something that might not be on the front page of the New York Times yet.
It really validates that consensus advantage idea we talked about.
Yeah.
The market is sniffing out the smoke before we see fire.
Exactly. Intelligence agencies spend billions to assess these things. Here, the market does it basically for free, out of pure self-interest. It creates something we call asymmetric information.
Asymmetric information.
It just means someone knows something that everyone else doesn't. Someone in Tehran might see a doctor entering a palace or a general moving troops. They can't call the CIA, but they can place a bet. The odds shift, and we see that shift before we see the news.
That is fascinating. The bet itself is the leak.
Precisely.
Okay, I think we need a breather. We've done inflation, shutdowns, potential war. Let's look at the lighter side of this data, because apparently people will bet on literally anything.
A sports and culture section. A necessary palate cleanser.
Let's start with the NFL. The Super Bowl always drives huge volume.
It's the original production market, really. Sports betting.
So we have a matchup here with 2 million in volume. It's the Seahawks versus the Patriots.
A classic rivalry.
And the market is pretty decisive. Seahawks are at 69%, Patriots are trailing at 32%.
That's a confident spread. But what I love about this is how it sits right next to the geopolitical stuff. You have a trader hedging a position on Iranian oil, then throwing a few thousand on the Seahawks because they like the quarterback.
It humanizes the data, doesn't it? Even masters of the universe have a favorite team. But the one that really got me was entertainment. We are looking way into the future here. The 2026 Oscars.
Which feels like a lifetime away.
We haven't even finished this year, and people are betting on Best Picture for 2026.
And is there a frontrunner?
There is a dominating frontrunner, a film called One Battle After Another. It's holding a 67% chance of winning.
2/3 chance. That is higher confidence than we have for the U.S. government staying open this weekend.
That's true. We are more sure about a movie winning an Oscar in 2 years than we are about our own government functioning on Saturday.
But think about what that implies. It means the buzz for that film is so strong, or the narrative around it so compelling, that the crowd has already anointed it. It connects right back to that consensus advantage. The crowd knows what the Academy likes, sometimes before the Academy knows.
It's like the crowd is reading the cultural tea leaves. It reminds me of how prediction markets often call election winners before the polls even close. They're just aggregating vibes.
Precisely. Whether it's political wins, financial ties, or cultural trends, the mechanism is the same. You get enough people, give them a financial reason to be honest, and a pattern emerges. It just filters out all the wishful thinking. You might want your favorite indie movie to win, but you won't bet $1,000 on it if you know the Academy's going to hate it.
So let's wrap this up. We've gone from counting the word inflation to predicting the fall of foreign leaders to picking Oscar winners. What's the golden nugget here for the listener?
The takeaway is that we need to stop looking at these markets as just gambling. The source material makes this really compelling comparison to AI models.
Yes, sir.
Well, an AI model ingests billions of data points to predict the next word in a sentence. Polymarket, or any prediction market, ingest millions of dollars from thousands of diverse human brains to predict the next event in history.
So the betting volume is the data processing power.
Exactly. And because people lose real money if they are wrong, the hallucinations, to use an AI term, get weeded out very, very quickly. If you bet on a fantasy, you go broke. If you bet on reality, you profit. It creates this relentless pressure toward the truth.
That's a powerful way to think about it. A truth machine fueled by greed.
A little cynical, maybe, but pretty accurate.
Before we sign off, I want to leave you, the listener, with a thought that's been nagging me through all this.
Oh, for it.
We saw there's an 87% chance Powell says inflation 40 times, a 75% chance of a shutdown. So here's the question. If the market is that sure, does the market predict the future, or does it just pressure the actors to stick to the script?
That's the ultimate question. It's the concept of reflexivity. If Jerome Powell sees the market, expects him to say inflation 40 times, does he do it just to avoid surprising everyone and crashing the market?
Does the prediction create the reality? Something to chew on.
Indeed.
Thanks for diving in with us. We'll catch you on the next one.
Experience the future of prediction markets. Get plugged into Big Brain today at brainbig.ai.